We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome back to Palisades Radio. I'm your host, Tom Bodrovics. Joining me today is Keith Weiner, president of the Gold Standard Institute and CEO of Monetary Metals, and also a PhD in economics. Keith, how are you today?
Doing good. Thanks for having me, Tom.
So you recently wrote an article about your views on the inflation versus deflation debate. So why don't we start there and kind of give us a broad overview, and we'll dive into some of those topics.
So I think the first thing one has to do is one has to untangle or unbundle what I call useless ingredients from the monetary forces that may push prices up or down. And yes, I did say down. So I call it useless ingredients because the regulators and sometimes the taxinators come along and say to, petroleum companies, you must put ethanol or MBTE in your fuel. And it's useless because number one, that doesn't do anything for your car. In fact, it actually makes power and fuel economy worse. And the consumer doesn't even necessarily know. Now that most people would be aware of, which is why it's a good example, because at least in the US, every fuel station has a sticker on the pump that says that it contains that from whatever it is, May to September. But usually these things, the consumer doesn't even know that these ingredients have been forced to be added to the product that they're buying, and they don't care, they don't value it at all. But it drives up the price pretty substantially. So people say, well, inflation. Or I guess it was about a year and a half ago, that California added, they already had a tax on gasoline, they added another 25 cents a gallon, I think. And at the time, everybody's outraged, all of what California's doing. 6 months later, they forget about it and they say, oh, inflation. And of course, gasoline is in the basket of consumer goods that comprises, consumer price index. So everyone says inflation. Mm-hmm. But these are non-monetary forces. And that's important. It's an important distinction. Number one, we want to know who to blame. Who's at fault for this? Not the Fed, when California does that. And number two, a non-monetary force is one and done. So they say, okay, now you have to put ethanol in there that adds 20 cents a gallon, or I don't know how much it adds, 50 cents a gallon, taking a wild guess, and then it's done. Whereas the monetary forces have positive feedback loops and resonance, and then lead to kind of a ratcheting, either a spiral up, which is what we had from 1947 to 1981, or a spiraling down, as we've had from 1981 to present.
So why is the twin to inflation a rising interest rate, Keith?
So a rising interest rate is both causing and caused by rising prices. So most people think, okay, well, the savers demand a premium in order to lend their money. But what they don't realize is that in 1933, when President Roosevelt took gold effectively out of the domestic monetary system and made it illegal to possess gold, he said, basically, you're going to be trapped in the dollar system, whether you like it or not. You're disenfranchised. There's no way not to be a lender, because to hold the dollar bill is to hold a Federal Reserve note. You're extending credit to the Fed who buys the bond. You could deposit that in a bank. Now you're extending credit to the bank who buys the bond, or you could buy the bond directly. But to hold a monetary balance is to be a lender. There is no way to express that preference. There is no such thing as a bond vigilante. So that's not it at all. So in my theory, I say, okay, what happens if the central bank pushes interest below marginal time preference? So normally, time preference, that's the line at which you would walk away if the interest rate fell below that. If your time preference was violated, you would withdraw your gold coin from the bank and say, I don't like this anymore. Mm-hmm. And in withdrawing your gold coin, you would force the bank to sell a bond to raise the cash to pay you. And the selling of the bond would push the bond price down and push the interest rate up. So normally there's a time preference, and the market rate of interest has to be above that. And what happens, so my question is, what happens if the central bank pushes interest below that? And so I'm just old enough to remember being a kid in the late 70s when pretty much my parents would take me to the grocery store every week. Pretty much every price of every item was up every week. It was up enough that I noticed it as a 12-year-old kid, and I wasn't paying for any of it. And I said, wait a minute, and so I started to think about inflation. Everybody was talking about inflation every day. It was on the news 5 days a week. They talked about the misery index, which is inflation and unemployment at the time. So what happens is, this is what my parents did, is they would stock up on whatever item they thought had the most reasonable price. 100 cans of tuna fish, 200 boxes of Kleenex, 10 giant tubs of laundry detergent, whatever it was. They would prefer to have consumer goods. So I call it a pantry balance rather than a bank balance. Mm-hmm. And so this is not just hoarding, it's an increase in the rate of buying consumer goods. And so there's a race condition between whoever's producing this stuff and whoever's consuming it. And the consumers are not only beating them, but the consumers are on the accelerator pedal. So that pushes prices up. Now, businesses realize this. And so businesses get in on the act, and businesses sell bonds in order to finance their inventories. And so not only are businesses financing inventories of raw materials, they're financing inventories of every, intermediate work in progress. If you have 17 steps in the production process, in between each one of them, there would be a warehouse full of partially completed work in progress. So the selling of bonds is pushing bond prices down, which is pushing interest rates up. And of course, they're buying up more and more and more raw materials and holding larger quantities of the stuff. And so the businesses are accelerating both the rising, prices of the commodities and also rising interest rates, because the businesses realize that the longer that you take between the purchase of your raw materials and the sale of finished goods, the greater the profits. The incentive is just totally perverse. Mm-hmm. And so you get this ratchet effect. Now, so interest rises, but unfortunately, time preference rises too. The consumers aren't stupid. Or it's actually the savers. And the savers and the consumers being largely the same group. They're not stupid. They realize that now inflation is accelerating. And so time preference rises, and so you're getting this ratcheting up from 1947 to 1981 approximately. And then some catastrophic things happen, which everybody thought was good. Credit Volcker and Reagan and all that. But this rising period is characterized by ever more borrowing, and that borrowing is chasing the interest rate up. It will borrow on an uptick in the interest rate, which is a very important thing, which we don't have today at all, in order to finance ever more, essentially hoarding of commodities. That no business operates that way today. They operate just in time. They operate lean. They have 100 different words for not having inventory in the system. So that was the monetary forces pushing prices upwards during that rising cycle, which we do not have today at all.
Mm-hmm. So as we know, the Fed measures inflation by the official CPI, right? The Consumer Price Index. So why is that measurement not necessarily a lie, rather just something else?
Why is it not what? I'm sorry?
Why is it not a lie? Why is it rather just something else, as you stated in the article?
I'm not a big believer in any of these sort of conspiracy theories that somebody is committing a plain fraud, like in plain sight. Same thing with manipulation of gold and all these things. There's a lot of dishonesty in the system, but it's usually more subtle than that. And the dishonesty has to do with the design of the system, not. So everybody, I think third or fourth grade, I don't remember when, we all learned that you can't add apples and oranges. You can't say I have 3 apples plus 4 oranges equals 7. 7 what? But when you get to have a PhD in economics, you say, well, not only can you add apples and oranges and rent and fuel, but then you can divide. So it's A plus B plus C plus D divided by some weighting factor equals inflation or consumer price index. I don't really think the math on that is really quite right. Number one. Number two, as I said, the force pushing prices up is increased useless ingredients. The monetary force is pushing prices down. And then number three, what goods do you include in there, and how do you deal with the fact? I'd written an article a couple of years ago looking at a Honda Accord, must have been 2019, because I remember in 1999, I compared a 1999 Honda Accord to a 2019 Honda Accord. And the 2019 did have a higher price. It had like triple the horsepower. It had like 17 airbags versus 0 airbags. It had, 16-inch rims versus whatever, 14-inch rims. Like every objective measurement that you could have of the number of air conditioning zones and vents and whatever, obviously, it went from probably cassette tape to, to DVD to Bluetooth. Like every objective and subjective measurement, handling the stopping distance, the car was a significantly better car that had way more like physical stuff in it, the sensors, the backup cameras, the screens on the back seat so the kids sitting in the back seat can watch movies. It had all kinds of more stuff in it. How do you compensate for that if you're trying to calculate some sort of index? And I think, the economists that believe in this sort of methodology are always debating what ought or ought not to be included in consumer price index. And I kind of just, from the sidelines, you just kind of chuckle and say the whole approach is, is at best a misleading exercise.
Mm-hmm. So Keith, where does that really put us today? Obviously, we've seen an uptick in interest rates recently, but how do you see, let's say, the inflation rate or the inflationary deflationary debate going forward here? And let's give it a timeline of the next 2 to 5 years.
So yes, interest rates have ticked up, although I note that from where we sit today at 1.7%, the interest rate is still below where it was pre-COVID. So we had a big drop down, and from that vantage point of 0.5% on the 10-year Treasury, we had a jump up, but so far not quite as high as it had been before that. I think in January of 2020, it was 1.8%. And so this, I think, has characterized the entire trend. If you zoom out and you look at 1981 to 2021, the thing that's the obvious is the down and to the right, is the obvious trend. But there's been little corrections along the way, and some not so little ones. I kind of feel like we're in the same debate that we're in around 2015 when, Janet Yellen said she's going to hike rates. And I said, there's no way. I mean, you can pretend and have a little abortive move. And some of my conservative friends said, well, she's trying to, it's cloud peeving, she's going to try to destroy the world. I said, there's no way the bankers are going to go along with that. And in any case, the forces that are, her hand is being forced anyway. And so, yes, we did have X number of rate hikes, all of which were undone. And, now here we are sitting again. So I just think that the forces that are driving interest rate down continue to drive it down. And that is, and so I referred to in the late 70s, businesses were borrowing and chasing the interest rate up. That's an extraordinary thing. Normally you have a market with bid and offer. And then for one side to be chasing the other up is an extraordinary thing. That means there's a sea change going on. And I just described what that was. Now, businesses' demand for credit is lethargic. It's sluggish. Mm-hmm. Everywhere you go now, there's a frenetic activity at the moment, and at least here in Arizona, with unlock with restaurants and shopping. It's in the middle of spring training and March Madness and all these things. But aside from that, and even pre-COVID, the environment was lethargic. You go into a restaurant and you see 2x, 3x extra capacity, and every restaurant is the same. And every shopping mall is the same, and everything is the same. And so the demand for borrowing exists on the downtick in the interest rate. So everyone is sitting there with their spreadsheets on their screen looking at, okay, here's how much I think I can make if I can borrow to buy another tool or borrow to build another store. And the business case doesn't work until the interest rate comes down. Then suddenly, ding, that box lights up green, you now have a business case. So the borrowing is on a downtick. My best example of this, or at least one that's I think the most approachable by the average person, is I don't know how it is in Canada, but in the United States, every car company is offering huge incentives to buy their cars. And they've discovered, many years ago, you can't just lower the price of the car. That's suicide. So what they do is they lower the price of the financing. And then when the financing goes to 0%, you extend the liens of the financing. So it's pretty normal for car companies to offer 0% for 72 months, with a couple of them 0% for 84 months. 7 years at 0% interest. Now, that's been that way since even before Janet Yellen's abortive rate hike attempt in 2015. And so as the rates were driven up, I estimated in one of my articles that was costing Ford Motor Company, something like $1.5 billion. The difference in the cost of interest between, before the rate hike, when it was basically zero, to after it. And that's a subsidy that they're offering to the consumer. The increase in the cost of the subsidy during that 1.5 year period was like $1.5 billion. Why didn't Ford pass through to the consumer the increased cost of the credit? And the answer is obvious, because then the demand for their cars would have fallen off a cliff. Mm-hmm. That's why. So that's sort of a way to look at this. Is you see no demand for credit when the interest upticks, only on the downtick. Mm-hmm. And that's where we're at.
One of your lines in that article as well, Keith, is that the Fed has been solvent, hence there has not been hyperinflation. So when liabilities become greater than the assets that the Fed holds, will that result in the hyperinflationary environment that some speak about?
Yeah, so very, very fascinating idea. If you had interest rates rise dramatically, so the Fed has a giant balance sheet, many, many trillions at this point. I haven't looked at it recently. Must be 5 trillion or something, yeah. 4.5, something like that. So they're borrowing largely overnight from the banks, which means if the interest rate rises, then the Fed's cost of financing its portfolio will rise instantly. However, it owns assets. The last time I had done this analysis, the average maturity in the Fed's portfolio was 12 years. So what happens to a 10-year bond when the interest rate rises is the bond price falls. So if we had a dramatic rise in interest rates, then two things would be happening at the same time. So the Fed's interest that it's earning on the portfolio isn't changing. The cost of financing is going up, and that could rise above what it's actually earning on the portfolio. So there's a negative cash flow. Mm-hmm. So that's one definition of insolvency, is you have a negative cash flow with no cure. And the other is the value of the asset is falling, the market value is falling, but the liability, of course, is hard. So if this falls below this, then we solve it that way. And so a couple of my articles, I've sort of theorized, okay, as long as the Fed is buying good assets, so liability is less than assets, interest expense is less than interest revenue, then, I want to preface this by saying there's a ton of horrible, damaging, the Fed wreaks havoc in the economy by doing this. It's not in any way an apology for this. But when I say they can seemingly get away with it forever, maybe that's the best way to say it. It seems to work. It just goes on and on and on. Everyone predicts hyperinflation doesn't happen because the Fed is solvent. Everything's ticking now. It's undermining the economy in 100 other ways, pushing jobs and wages down, and the wealth effect is making the 1% appear richer and richer and richer. So it's creating social strife, all kinds of things that are coming with this. But it continues to work, or it seems to work. But if the Fed had a negative cash flow, now it has to create new dollars, not to finance the purchase of new assets, but to simply feed its negative cash flow. That is a death spiral. So it incurs more liability, which is paying interest on, to pay out an expense, which generates nothing for it in the future. And then next year, the shortfall grows a little bit, grows a little bit, grows a little bit, and that will spiral. And that will be the Weimar, Zimbabwe, Rudy Havenstein moment, that Minsky moment that everybody, either dreads or in some ways, some people I think are looking forward to it with a certain glee. But that's when that will occur, and I think that's years. I mean, horrible things are coming, but I don't think that quickly.
Mm-hmm. So Keith, as we've seen, obviously, that there's been stimulus checks put out by the Fed. So if the banks will not or cannot be a conduit for the Fed to pump credit into the economy, then the Fed must construct a pipeline around the banks that can carry the necessary pressure. So what could a solution to this problem be?
Yeah, so the background to that is that we have an irredeemable currency. And in very brief terms, that means that there is no way to extinguish a debt. When you pay a debt using a Federal Reserve note, you pay a debt using an IOU, you just shift it around. Mm-hmm. So the total debt only grows. And because it's accruing interest, the debt must grow exponentially. It must grow at least the accrued interest. And actually it turns out quite a bit more than that, because you have to make sure the marginal debtor gets enough dollars in the form of revenue, that is, to service their debts. Mm-hmm. So what the Fed had always done in the past, and in collusion with the banking regulators, is loosen little bit by little bit the regulations on lending and how much reserve requirement you need. Recently, they've eliminated all reserve requirements and lowering the interest rate. It gets to the point where the analogy is pushing on a string. You just can't generate any forward motion with that string anymore. So there's a lot of talk about so-called Fedcoin. I think the conservative view of Jay Powell as well. Maybe we have to respond to Bitcoin and respond to China. The Chinese government has either done or announced a Bitcoin-like digital currency. On the left, the Janet Yellens of the world are saying, well, maybe this is a way that we can bring in the unbankables. We can include the unbankables. But the real reason, I think, is that if you're in the position of having to force feed more credit into the economy, and the banks are unable or unwilling to act as a conduit, you have to go around them. And so by issuing its own Fed coin, essentially the Fed can become a deposit-taking institution, completely, cut off the commercial banks, take over their business, and then they can make whatever loans they want, and continue to fuel credit out, as fast as their alchemists and magicians and illusionists tell them that the magic incantations of today say the right amount of credit is, X, and they can pump that out.
Mm-hmm. So what problems does this solve, Keith? Would it create a nearly instant feedback of monetary policy changes?
Well, it's a funny question. What problems does it solve? Well, I kind of liken it to, you make a series of bad choices, and each bad choice puts you now in a worse situation. Like somebody chooses to, mug an old lady, and then there's somebody who says, "Hey, you stop thief." So then he runs and decides to break a store window and steal a TV while he's at it. And then suddenly he's in an alley, and then the cops are chasing him. And with each bad decision he makes, he's just in a worse and worse situation. Well, now he's climbing up the wall. Maybe there's some dogs on the other side. So he throws the TV down and kills the dog. With each thing, does that solve a problem? Well, in a certain sense, it does. Mm-hmm. I mean, the dog was snapping at him, and now the dog is dead. But now he's added another crime to his list. And he's running out of options, and he's running out of time, but he's buying himself minutes at the cost of years or decades of his life later. So the Fed has the problem that if the marginal debtor can't get enough dollars in revenue to service his debts, the marginal debtor will default. And since the marginal debtor has a creditor, and the creditor is leveraged, typically, and the creditor is not only leveraged, but also is duration mismatching with their bank. So they're borrowing short to lend long. This is a long-term asset, and now they have short-term liabilities that they can risk being defunded. The Fed doesn't want a cascading, domino toppling kind of scenario like 2008 started to be. So that's the problem they're trying to solve by having this issuing the so-called Fedcoin. But yes, it leads to all sorts of additional problems. This is giving the one ring, to use the Lord of the Rings analogy, to Boromir or to Lord Denethor. And Lord Denethor is saying, we'll put it deep in the vaults, not to be taken out and used except in the utmost end of need. And you're giving the one ring to this guy, and that's the thing he's been lusting after. And what is he going to do with it? Lots of things, and none of them good.
Excellent, Keith. So you also recently wrote a couple articles, or not even recently, but you've written a couple articles on the, let's say, manipulation, or let's say a different way to look at the metals market. So from your perspective, why are they not necessarily manipulated, but why are they more used by the banks to make money on arbitrage?
Well, so if you're a bank, the thing that you want is a predictable, maybe I'll use a sort of borrowed term from Keynes, rent. You've got all this capital that you can get at dirt cheap rates, courtesy of the Fed. Mm-hmm. You can get as much as you want at LIBOR, or LIBOR plus 5 basis points or something like that. All you really need to continue to be in your position of both power and making lucrative returns is to find a way to rent it out. And I've written enormous amounts, and on our website we have free charts. I think there's 60 something different charts on the website, looking at sort of the internal structures of the gold and silver markets. But basically, you can buy a bar of gold and sell a futures contract against it. And the reason why you do that is the price of the futures contract is higher than the price of the bar. Mm-hmm. So you're buying for here and you're selling for here, and you're making, it's not a huge amount of money, but it's very predictable. You can do that over and over and over and over again. And the spread is typically a little bit larger than your cost of borrowing, which is LIBOR. So as long as you can do that, you're in the money. And so I argue the banks are arbitragers. They're not, so of course people see the short position, the short futures, because that's reported in the COMEX data every day. They don't see the long gold position because that's a gold bar that may or may not be in a COMEX vault. It could be in another vault. There are lots of vaults in the world, and only some of them are COMEX registered. And the bank may be buying in another vault simply for the reason that there's a spread between India and New York, or Hong Kong and New York, or Singapore and New York. You want to buy it in the cheapest place. So instead of making this spread, you're buying it cheaper, you're making this spread instead. And then if you have to, you ship it there. Pretty much any 2 points in the gold market are less than 24 hours apart by airplane. Gold is so value dense that it's pretty cheap to ship around. If you're a bank anyway, you're doing it at those kind of scales. And so they're arbitragers. Now, what I've done in looking at is there manipulation, is I've done the same thing as I asked with what happens if the central bank pushes the interest rate down. I asked the question, okay, suppose it were manipulated. What can we find a corner case? Can we find some place that we can look for an observation that the manipulation theory would predict one behavior and the arbitrage theory would predict the opposite behavior? This is what physicists do all the time. Mm-hmm. Einstein hypothesizes X and Y and Z. He dies 50 years before anybody can build a telescope big enough to go find one of those objects, or put a telescope in space, I suppose. And then some other physicist, Lorentz, theorizes something different. Now you have to say, okay, what's the case that they predict opposite? Light is going to bend this way, light's going to bend that way, right? And so they finally put the Hubble Space Telescope up there, and then they find one of these super duper magnetic pulsing quasars, whatever, and then they say, aha, light bends to the left. Einstein is vindicated, Lorentz goes into the dustbin. What is the case that if the conspiracy was correct, and that is each futures contract has a finite expiration date, and before that expiration date is first notice day, that you must sell. If you have a contract that you don't intend to either take delivery on, or if you're short and you don't intend to, it's called stop or make delivery on, mm-hmm. then a month before the final expiration, you have to get out of that contract. So suppose the banks were carrying a massive short position. That is, they don't have the metal and they don't intend to ever deliver the metal. The purpose of the short position is non-economic. The purpose is to manipulate the price downwards rather than any other purpose. What would you have to do as you approach first notice day? You have to close that position. What does closing a short position mean in the markets? It means buying. So the banks must be buying with urgency heading up into first notice. Now, what would that do to the price of that one contract compared to, let's say, spot price, or compared to all the other contract prices? Enormous buying pressure with urgency would push that contract up. So now here's our corner case. Their theory, the manipulation theory, predicts that the price of the expiring contract will head upwards as it approaches first notice day. The arbitrage theory says the bank is indifferent. They own a bar, they're short a contract, they're happy to either allow it to roll if they can make more money, additional profit by rolling it, or they're happy to say, here's your bar. But it's the long who's the speculator, who hasn't got the cash to pay delivery, who has to sell that contract and roll it to a future. And so all of that selling with urgency would predict that the price of that expiring contract is going to go down. So I wrote an article called Thoughtful Disagreement with Ted Butler. And the essence of the article is to show a graph of every expiring contract in gold and in silver going back to 1996. And guess what they all do? And it's all these traces are laid on top of each other. And all of them cascade downwards. So I say this is the data, this is the theory, this is the question that this theory leads you to ask. This is the data that shows what happens. This is the answer to the question. Gentlemen, I respectfully submit this for your consideration and debate, and tell me I'm wrong. Tell me either my theory is wrong, my question is wrong, my answer is wrong, my data, whatever it is, have at it. And all I got was a couple of F-bombs and crickets. Oh, and then the one site in particular I thought was amusing said, what Weiner doesn't want to know. And I'm like, I've spent years and a lot of money building the software to get this data and licensing the data. Don't want to know. Is that the best that you can allege about me? Is something I don't want to know?
Mm-hmm. One of the quotes that I pulled from that article, Keith, is that the claim that they sell actual metal is interesting because the central banks don't have any silver. So if this claim were true, they would be able to suppress gold, but not silver. So why would that be, Keith? Can you explain that to us? Yeah,
okay. So what happens when somebody is married to a conclusion and they're using an argument only as a tool, as a means to an end, and then you attack their argument with sufficient debunking force, what they do is they pivot to another argument. They say, oh, no, okay, yeah, you're right. And I've had a couple of prominent conspiracy types on Twitter. Yeah, you're right. The way they're manipulating it isn't via the futures market. Okay, and I'm waiting for it. But they are manipulating it, and the way they're actually manipulating it, and then they just smoothly pivot to the next argument, which is, well, they're selling metal. Right, so the central banks are selling or leasing, and they think leasing is the same thing as selling, which isn't. They're selling metal, and that's how they manipulate it. I'm like, okay, if they're selling metal, they haven't got any silver. So that means they would only be pushing gold down, but not silver. Silver would be the true market price. And at the time I was saying all this, the gold-silver ratio was, in the range of 80. I mean, wouldn't you expect the gold-silver ratio to be low? And gold was pushed down and silver was not? I mean, how do you explain why silver is so cheap if the mechanism of suppression is to do something that they can't do with silver if they haven't got it? Mm-hmm. So then they just pivot to the next level. They're doing with forwards, not with futures. It's your data, futures. And I think at some point it's a mistake to keep chasing after the heads of the Hydra, chopping away with your sword, and then it just sprouts another head or another two heads, with each one.
So when we're observing, let's say, the gold or the silver price, Keith, what causes sharp drops in the paper market price, and why do they tend to occur at very illiquid times of the day?
Well, remember, some of these times is when either Australia or Asia or Tokyo is opening. Mm-hmm. So that's their morning. And then somebody has a margin call or somebody has whatever. But when somebody says the paper price is dropping, I always want to kind of come in and say, are you saying that the price of physical metal didn't drop with it? Because this arbitrage I'm talking about, paper and spot track very, very, very closely. I'm so close that if you zoom out and look at something with a scale of $0 to $2,000 and you're seeing the price on there, it's basically one trace with maybe you can sometimes see the shadings tilting one or the other direction because they're half a pixel apart or something like that. So the price of metal is moving, at the same time. Why did the price go down? Because they're selling. Now, we can look deep into that by looking at basis analysis and see whether basis is rising or falling. So if the price drops and the basis rises, the basis is essentially future minus spot. So if that widens at a time when the price is dropping, that means it was selling the physical. And if that narrows or inverts for a while, then that would be selling paper. And there, both of those incidents occur. And obviously, people who buy futures contracts are short-term traders. Why are they short-term? Well, there's a cost of doing it. You're doing it with leverage, and so there's extreme risk. And either do it to take profits or they do it to stop losses. And so something happens, they wake up, their trading day starts in Asia, and which is kind of middle of the night here, and they either say, okay, I want to cut my losses, or they say, okay, that's enough. I think the chart's rolled over on whatever chart they're looking at. Time to get out before I lose all my gains in the next couple of hours. Mm-hmm. But I think I said this on social media the other day. If there was a durable pattern where at the end of the day or the middle of the night or whatever it was, you could count on a drop, then instead of complaining about it, you should profit from it. That is, go buy right after that drop, and you're guaranteed certain profits. Mm-hmm. And then usually at that point, usually people stop pushing on it because they realize, no, they don't want to risk their own money doing that. So it's a better argument than it is a trade.
Mm-hmm. So Keith, do you have a possible explanation for why the short positions in gold have recently been falling at a relatively sharp rate?
So as the basis contracts, so the basis is the profit for putting on this carry trade. Buy metal, hold it in the meantime, and sell a future against it. Mm-hmm. The wider the basis spread, the more people want to put that trade on. So if there's only a penny to be made, maybe there's one guy in the world who's like, okay, I'll take it for a penny. It goes up to 2 pennies, and then there's 2 guys in the world. It goes up to 30 cents, and suddenly there's a whole crowd doing it, and it goes up to $5, and everybody and their uncle gets in on it. So, if you watch the basis as a spread, there tends to be a pretty good correlation with some lag. What people are calling short positions that are really carry positions, but you can only see one side of it because there is no reporting of the ownership of the physical bar. The more profitable it is, the more people that add to the position. The more the profit is sucked out of it, the more people will close the position because they have a better use of the capital, and they certainly won't be adding to it. And so, the basis has been kind of trending down the last couple of months as the price has softened. So there tends to be a bit of a liquidation of future speculation, which is probably a healthy thing anyways. And with that, you're going to see, demand essentially to warehouse the gold declining as, ultimately it's the speculators that are buying futures with leverage that give the warehouse guy his profit to carry gold.
Interesting, Keith. So what is the main driver for higher gold and silver prices that we need right now? Is it linked to real yields or a flight to safety trade for institutional money?
Institutions as a whole, we sort of leave that aside for the moment. I would say in general, it's, I guess it's the combination of risk and return in, conventional investments. And of course, the risk isn't really changing that rapidly. It's the perception of risk. I heard a great one a couple of months ago that, I think I'd heard this years ago, but it came back. And that is, in science, knowledge is an ascending spiral. In finance, knowledge is cyclical. So right now, there's no perceived risk to borrowing $1 billion to buy Bitcoin with it. That nobody involved in, let's say, governance of the board, the CEO, not that I'm a big believer in securities regulation, but the securities regulators, nobody sees any issue with this right now. Because Bitcoin's basically been a one-way, trade since 2019 or thereabouts. So when people have a greater perception of risk, then they're going to demand a greater return. And if they're not getting that return, then what are they going to hoard essentially as a way of avoiding it? And so what happened with COVID is at the same time that the yield you could get on the conventional treasury investment collapsed, went from 1.8% or 180 basis points to 0.5%, 50 basis points. But at the same time that happened, the deficit, and I don't know how they get away with this particular gimmick. They quote, $1 trillion or something like that. But if you looked at April 1, 2019 to March 31, 2020, so that's right before the multi-trillion-dollar spending for COVID kicked in. $1.7 trillion is the increase in the Treasury's debt, according to the Treasury's own website. Okay. Then they passed the $2.3 trillion CARES Act, then almost immediately a $0.5 trillion supplement, total $2.8 trillion. At the same time, they took a wrecking ball to the economy. I assume that tax receipts must have fallen by $1 trillion. So, you added, $3.8 trillion to the deficit. At the same time, you took away most of the return. It was logical for people to buy gold. I mean, why not? Mm-hmm. The opportunity cost, there's no opportunity cost anymore. Now we have 1.7% on the Treasury. People might be feeling, hey, that's not a bad deal. And so if you want to compare Treasury rates to another rate, I would say compare it to time preference rather than comparing it to CPI inflation. So if Treasury rates are above time preference, people are happy to buy Treasuries. If the Treasury rates are below time preference, then what are they going to buy? So 1.7%, maybe they've reached that magic point where there's not necessarily that much demand for gold. Now, that said, a point that I make all the time is that all this debt, including the Treasury debt, is fundamentally unsound. It's counterfeit credit. So that means that ultimately it's headed for default. So do you want to own something you want to own bad paper? Do you want to own fraudulent, bonds? Maybe as a quick trade, but at some point, I think a lot of people sort of permanently opt out and say, well, that's like, I guess the expression is picking up pennies in front of a steamroller. I'll make a trade today, but I'm sure I'll be out before there's really a problem with it. Mm-hmm. Yeah, but okay, are you really that sure?
Yeah, no doubt. So Keith, something that we haven't touched on in a little bit here, and you mentioned it there. Why is Bitcoin not the future of money?
So I've written 13 or 14 articles, I think, arguing that Bitcoin is not sound and Bitcoin is not money. And, each of those articles focused on a different, and they're all sort of monetary science. I'm not trying to look at predicting the price. So I wrote most of those articles from around May to December of 2017 when Bitcoin was skyrocketing. And I found that I rather enjoyed kicking it while it was going up rather than waiting for it to go down. Then everyone was kicking it in 2018. I was out at that point. And the last article I wrote, I said something like, I have no idea where the Bitcoin price is going to go. Is this the top? Is it going to go to 1 million? I have no idea, neither does anyone else. As it turns out, I almost perfectly top-ticked the price. But admittedly, I had no idea. That's what I said. But what I was saying in these articles is I'm looking at things like the fact that Bitcoin can be forked. And I said, doesn't this disturb anybody? I mean, imagine if, I like to use Wile E. Coyote and Roadrunner in a lot of my examples just because, I don't know, I grew up with that stuff as a kid watching the cartoons. But so imagine there's a Roadrunner bank and there's a disgruntled employee who says, I'm gonna steal the ledger books. I'm gonna copy the ledger book. I'm gonna go open up Wile E. Coyote Bank across the street. I'm gonna say to all of the customers of Roadrunner Bank, your deposits will be honored here also. Is this some new kind of crime? Does the Fed or do the regulators need to go pass a new regulation to prevent this sort of crime? No, of course not. Because with real banks, copying the ledger of liabilities is of no use unless you actually own the assets. And since you can't copy the assets are a real thing. You have a mortgage on a piece of property, there's a deed recorder, in the county office somewhere that says, okay, this property is owned by Keith Weiner and then there's a bank that has a lien on it and whatever. You can't copy that. That's the real asset. You could just copy the liability that says, okay, we, the bank, owe you, Tom, $100,000 in your savings account, but it'll be no good without the assets. And so what this shows is that Bitcoin is a ledger of liabilities only. There is no asset side, and so it can be copied. And the fact that the copy wasn't worth the same market price or market cap as the original, yeah, okay, that's true, but that doesn't really answer the criticism. It shouldn't be possible to copy it at all. This is creating value ex nihilo, out of thin air. And there's something unsound about that I think people aren't curious enough about. People should be more curious about these things. So what does that mean? Anyway, so I've written 13 articles, each one sort of looking at a different problem. Obviously, I'm famous or infamous for being totally dead set against the quantity theory of money. I probably attack that more aggressively than I have the gold manipulation theory, and I've attacked that quite a bit. Mm-hmm. It's a quantity theory. You can't understand money in terms of quantity theory. So Bitcoin has no mechanism to stabilize its value. It has a great and very elegant mechanism to stabilize its quantity, which is by most people presumed to be basically the same thing. It isn't. And so as long as the value is banging up and down like a yo-yo and with afterburners, then nobody could really advise their grandma to put 100% of her life savings into Bitcoin. So it's on the buyer side is going to be speculators. And then on the borrowing side, who in their right mind would borrow something? The proponents of this will tell you it's going to go up 100 or 1,000 times. So you're buying a house and you say, okay, I'm going to have a $2,000 a month mortgage, but they're promising you that it'll be $2 million a month to pay your mortgage within the next few years. Nobody can do that. So there can't be any borrowing, there can't be any lending, which means Bitcoin cannot be used to finance any productive enterprise. We've lost sight of the fact that money is ultimately used to finance something productive, and that's how we as a civilization go forward. We can't finance anything productive, then watch out. And I just want to put in a plug for monetary metals. We're using gold to finance something productive. It's not just a bet on its price. It's actually financing productive businesses. And then that was how gold had been used up until 1933. The government artificially stopped it, but it didn't alter gold's economic properties. It's still just as good as it always was. Bitcoin cannot address that question. How could you finance anything productive with something so unstable in value?
Yeah, and that's a program that you guys started where you actually pay out gold on a gold lease, correct?
Right. So the investor deposits gold with us. We pay them effective interest to lease out the gold with their consent, and we also lend gold. So we announced the first gold bond in 87 years, Christmas Eve, December 24th. And so we have more bonds coming and more leases coming. But the key point here is everybody should be concerned with how do productive things get financed. I mean, it's all well and good. You buy this thing that goes up and now you're rich. But rich doesn't mean anything if all the things that you would want to purchase can't come to market, can't be created, can't be produced because they can't be financed. Mm-hmm. How is anything to be financed? And the answer is the dollar. I mean, other than monetary metals clients, all financing in the world is financed by the dollar or one of its derivatives. So CAD is a USD derivative. Euro, pound, even yuan, they're all dollar derivatives. And they all have the same, glaring defects. So that's what, I guess if I left everybody with a takeaway, it's being more curious, ask these questions. What does that mean? What happens when? Yeah, but if that were true, then what about this? Mm-hmm. And that's, I think, scientific inquiry at its best.
I couldn't agree more, Keith. Of course, we can find out more about that program and quite a bit of your writing at monetary-metals.com. Anywhere else you'd like to point our listeners to, Keith?
My Twitter is at KWiener01. And on Facebook, I'm Keith Weiner, Keith.Weiner5, I think. There's a 5 in there anyway, not on the Facebook syntax, but
perfect.
I'm pretty prolific. I'm out there saying my controversial stuff.
It's I do really appreciate your articles. They really, exactly as you say, they make people think, and I've enjoyed digging into them. Keith, thanks so much for your time today.
Thanks for having me, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.